Top real reasons to invest in gold, not price. In the last video, we discussed why it is a mistake to solely focus on the price of gold when considering it for your portfolio. Now we will cover the actual fundamental reasons why you should hold gold. Reason 1. Protection against currency destruction. The mathematical reality of fiat currency is straightforward. Governments can create unlimited amounts of it. This is literally how modern monetary systems function. When you hold dollars, euros, or any other paper currency, you own a claim on purchasing power that governments can dilute by expanding the money supply. Gold provides a counterbalance to this structural dynamic because of basic geology and economics. All the gold ever mined throughout human history would fit in a cube roughly 22 meters on each side. New gold production adds only about 1 to 2% to total supply annually, constrained by the difficulty and expense of mining. This scarcity doesn't depend on policy or government promises. Planetary formation billions of years ago determined it. The purchasing power comparison becomes stark when you examine long time frames. In 1913, before the Federal Reserve's creation, a $20 bill and a 1-ounce gold coin had equivalent value. Today, that same paper buys considerably less than it did then, while that ounce of gold is worth well over $4,000. The gold maintained its purchasing power. The currency did not. This matters enormously for retirees living on savings accumulated over decades of work. If you spent 30 to 40 years building a nest egg, currency debasement can silently erode that purchasing power even if your account balance looks stable. A portfolio allocation to gold directly addresses this risk without requiring you to forecast when inflation will accelerate or which policies will debase the currency. The protection operates continuously, quietly maintaining value while paper assets fluctuate. Reason 2. Uncorrelated performance during market stress. Most diversification strategies fail when you need them most because assets that normally move independently suddenly correlate during crises. Stocks and corporate bonds both declined in 2008 because both depend on corporate profitability and credit availability. Real estate and stocks both suffered because both depend on economic growth and credit conditions. Even international stocks provide less diversification than many realize because global equity markets increasingly move together. Gold genuinely behaves differently because it responds to different drivers. When stock markets decline because of recession fears, gold often rises as investors seek safety. When bond yields fall during flight to quality episodes, gold appreciates alongside them. When both stocks and bonds struggle during stagflation periods like the 1970s, gold can surge while traditional assets languish. The mechanism behind this low correlation relates to gold's role as a monetary choice as opposed to a productive asset. Stocks and bonds represent claims on future cash flows generated by economic activity. Real estate generates rental income. These assets all join in the economic cycle. Gold doesn't generate cash flows. It simply exists as a scarce, universally recognized store of value. However, we will discuss a means of investing in gold that does generate a yield very soon. This basic difference creates the diversification benefit. During periods when stocks surge, the gold allocation might lag, but during market corrections and crashes, gold stability or appreciation offsets equity losses. A common objection to gold and silver ownership is the opportunity cost of potential gains in the aforementioned risk assets. The answer to this are gold and silver leases. Gold and silver leases provide investors with the opportunity to gain a competitive interest rate that matches or exceeds the yield on bonds. Monetary Metals is a gold investment company that delivers a real interest yield on gold, paid in actual gold. See the link to Monetary Metals fixed income products in the video description and get started earning a competitive interest rate in addition to gold's natural price appreciation. Fill out their short contact form to get started. Reason 3. Ownership without institutional dependency, also known as counterparty risk. This characteristic deserves more attention than it typically receives. When you own physical gold coins or bars, you possess an asset that doesn't depend on anyone else's solvency, honesty, or competence. There's no counterparty who can fail to deliver, no institution that must remain solvent, no government that must honor obligations. Compare this to stocks, which represent partial ownership in companies that can go bankrupt, or bonds, which are promises to pay that can default, or bank deposits, which depend on the bank's continued operation and the deposit insurance system's funding, or even real estate, which needs enforceable property rights and a functioning legal system to maintain title. Physical gold needs none of these intermediaries. The metal itself has intrinsic value recognized globally for thousands of years. If your bank fails, your gold stays valuable. If the stock market closes during a crisis, you still own your gold. If a company goes bankrupt, your gold is unaffected. If political upheaval disrupts property rights, gold stays portable and valuable. The 2008 financial crisis illustrated this distinction vividly. Bear Stearns shareholders watched their stock value evaporate. Lehman Brothers bondholders recovered pennies on the dollar. Money market funds broke the buck, returning less than investors deposited. Meanwhile, physical gold owners simply held an asset whose value actually increased during the chaos, rising from around $800 in early 2008 to over $1,100 by late 2009. This counterparty-free characteristic provides psychological benefits that extend beyond mathematical portfolio optimization. During market turmoil, when headlines scream about bank failures and corporate bankruptcies, physical gold ownership offers genuine peace of mind. You're not wondering whether some institution will honor its obligations. You hold direct ownership of a globally recognized asset. Trying to buy gold after stocks have already crashed defeats the entire purpose. You've already suffered the equity losses, and you're now buying protection at elevated prices. Finally, certain gold investing vehicles can provide tax-deferred growth. Gold IRAs are a tax-advantaged way of owning physical gold and silver without the need or liability of storing the actual precious metal in your own residence. These gold IRA companies provide lifetime customer support, competitive price matches, buyback guarantees, low fees, and secured storage. See the links in the video description to find the right gold IRA company that fit your individual needs. Fill out their short contact form and receive a free gold IRA guide. In the next part, we will expand on the top real reasons for investing in gold. Be sure to like and subscribe so you don't miss it. Thank you for watching.